Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Orient Abrasives. Is it a value buy at around 2021 rupees or is it an avoid? So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Orient Abrasive, here's a small request that kindly support me on Patreon. And once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up on a daily basis. For detailed market or company talk or a number of stocks that you are holding, you can directly email me and we can work things out. Now about the company, Orient Abrasives was established in 1974 and they are the largest manufacturers of calcined and fused alumina products. Manufacturing facilities are in 8 countries. Key products are high alumina raw materials, monolithic and ceramic propellants, etc. Usage in iron and steel industry, which have been doing well, steel industry over the past few months. Part of the Ashapura Group established in 1960. If you look at the financial, these are Q2 numbers, September FY21 numbers versus Q2 FY20. And although many companies have reported a decent Q2 numbers with sales increasing year on year as well as profitability, but here in the case of Orient Abrasives and the fact that they are in an industry which have been doing well over the past 1-2 quarters, the results ought to be much better than what it came out to be. So sales dropped by around 17-18%, profit dropped by around 67%, 2 crores versus 6 crores. There is good high promoter and decent institutional holding with 18% free float, no denying that. Operating profit margin of 14%, net profit margin of 13%, return on equity of 7% is decent. I won't say it's out of the world. I won't say it is the best in the industry and everything, but it is quite decent. But the numbers on the top and bottom line is nothing to gung ho to write home about. So why the stock is down? Basically, I'm looking at from a 5 years perspective, the stock is down appreciably. Although on a yearly basis at 2021 rupees, it is nearing its 52-week high. But I still believe that the reason for it being down from all-time highs is that there is very high raw material cost, and raw material cost is rising for the company, plus transportation cost is rising. If you remember in 2015-16, oil was at $16 per barrel, $15 per barrel. Today it is $40 per barrel. Then there are raw material costs with respect to other raw materials that are used in mining, in taking out these products, and everything that has risen. Global shutdown of industries have also not helped. So many industries have shut down where they used to supply their products as raw material, and that has led to a domino effect, and the sales are not coming through. And with the kind of numbers that they have produced in Q2, I won't be surprised if Q3 is not that great either. Because there is a localized lockdown that is taking place, localized shutdown that is taking place globally, I don't see December or March quarter getting better. Probably FY22 onwards, things will look very, very good. So things are not looking that great, and that's why it's not at a 3-4 year high, and it's currently still trading at around 20 rupees. Debt has increased over time, and basically interest burden has increased more than debt. So what has happened is, because of them not making a lot of profits, they are not able to pay back debt that quickly. So they have not increased debt, but the interest burden has increased. uh, Profit growth has been very flat for the last 3 years, and it looks like this will be the fourth year in which the profit growth may be slightly declining rather than being even flat. So basically, their growth and revenues and profitability is going in the wrong direction, and that is why the stock has been bruised and battered. Debtor days has increased, and return on equity of around 6-7% is not great compared to other industries. I would say that it is reasonable for the industry that they are working in, but people or investors have a lot of a plethora of industries to invest into. There are companies with ROEs of 25-30% even in this pandemic doing really well, and it looks like their ROE is going to increase and people will look for such companies. So these are the primary reasons as to why stock has been totally gone out of favor with investors. So what needs to be done? In my opinion, avoid for the time being. Even with this kind of an up move, do not fall into this trap. Remember that in a bull market, when this is a raging bull market in mid and small cap, every duck will look like a swan. Things would look rosy all the way, and you would like to buy whichever stock you feel like it has reasonable value. But the problem with that is it has come to certain value after being in abysmal condition. So the stock is not great, the company is not great, it's just that it has moved up because of the bull market. And there are companies with exorbitant, you can say, PEs, etc., but they are the blue chips or the best in the business, be it in the small, mid, or large caps. And albeit they are trading at 70, 80, 100 times, any level of little correction is a buying opportunity, because going forward, when things normalize, they are going to produce even better numbers, and so the PE would sustain. The PE would probably go down and earnings would go up. So that is the thing, earnings will catch up. So that's why getting into such companies is a better option rather than buying into companies where you feel that there is value but the market doesn't feel that way. So wait for numbers to improve. Wait for sales and profitability to go at least 20% CAGR, that you see a growth over 2 3 years. So wait for the company, look at the company for the next couple of years, how the numbers pan out. Even if you have to buy at 40 45 rupees and not at 20 rupees, that is fine until and unless the numbers are coming in. So let things move on ground. Wait for the numbers to improve. Buy cash rich businesses. Better to buy into simpler businesses that you understand. I have kept on saying that, and I would say that it is much better to buy cash rich, cash generating businesses, consumer businesses, not FMCG, but there are many other consumer oriented businesses that you can buy directly or indirectly that are related to you. Have a good 5 year perspective by buying those stocks. Be patient with them, and accumulate on dips, and you will make money over 4 5 years. Maybe not immediately. So kindly take that into consideration. Probably this stock for me, in my opinion, would be an avoid, but take your own call. Disclaimers do apply, and put only 5% of your total income. So this was my video on Orient Abrasives. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.